Just Two Traders is a raw and unfiltered viewpoint discussion between two traders and their respective guests. The commentary here and discussion of any investments may or may not be appropriate for you as an individual or entity. This is not directed or tailored advice to any individual or entity. Take it away, Sam.
It is important to consult your owner financial planner, accountant, and or attorney to determine suitability of any and all discussed investments. Basically, be responsible and make your own decisions. Remember, this is
Just Two Traders hunting the market.
Well, good afternoon. Hope everybody's doing well today and the markets are treating you accordingly. Hopefully so. So this is a, I guess, special little broadcast / discussion, if you will, about the Bretton Woods III analysis that came out of Credit Suisse. So we've been talking about this, or I should say I've been talking about this for a bit now. And long story short, it's gotten to the point of, I would tell you, I guess, a degree of urgency, I think is maybe the most appropriate way to put it. In terms of needing to have a real discussion. And so we've been having this discussion for the last couple days in our Discord since the article came out. And we tried to do a Twitter space, the other day, and spaces crashed on us. So apologies to those of you that were listening there and didn't get an opportunity to hear the, I guess, summary, synopsis, or thesis associated with this. So for those of you that missed it in the Discord, and those of you that missed it on Spaces, I've decided to do it in a little bit more of a formal presentation. So that way you guys can go ahead, listen to it, and understand a little bit more about, I guess, what is being said would be my point. So without further ado, I've got my big red crayon. Hopefully I didn't test it. Sure. Okay, cool. I do. I've got my big red crayon. So let's go ahead and we'll get into it, and we'll talk about what all this means. So anyway, Bretton Woods III, right? Go back. We fucked everything up pretty much. That's pretty much the synopsis here. Okay. So first of all, if none of you know me and have not, I wouldn't say necessarily had the pleasure, maybe more the pain of enduring my rants, I am Tom, aka The Real Tomato on Twitter. And I am the CEO of Just Two Traders. So all these people out in social media land, why the hell should you actually listen to what I'm saying? What are my credentials? Without giving away too much, I am middle-aged in nature, balding, not young and balding. I'm old and seasoned is what I like to call it. Middle-aged ex-suit money manager guy, and ex-management consultant, and I have 3 degrees that actually they actually have multiple majors inside of those degrees as well. Long story short, a background in engineering, design, finance, investment management, strategy, operations, supply chain, logistics, Lean Six Sigma, Agile, Dev. I've worked in everything from aeroderivative power generation to prosthetic device manufacturing to big tech to, again, being a fully licensed individual inside of the financial world or realm, if you will, aka the suit. So my perspective and my education, and I would tell you my career, has given me the ability to look at things at a high level, macro level, right? So I'm not a specialist there's some things I am very specialized in, but I'm not a specialist, right? By nature, okay? I'm a foot deep, a mile wide, right? Versus, for instance, somebody that's going to be, that foot wide and a mile deep, and that's totally fine because that gives me perspective. It's served me well over the years. So anyway. Why we're here. So what is Bretton Woods? You've probably been hearing about it. You've probably got a basic understanding or grasp on it, but really what it was the ability to take all these countries and their currencies and bring stability to exchange. And that started in World War II, right? And the Bretton Woods Agreement. And the idea here was we're going to peg or tie our currencies to the quote unquote gold standard, right? And so your currency will be based upon essentially that commodity which you hold inside of your country, right? And then that's what will give it value. So you've heard the term, he who has the gold makes the rules. Well, there you go. He who has the gold makes the rules. In this case, the United States had 2/3 of essentially the gold. Okay, right there. So there you go. 2/3 of the world gold. So being 2/3 of the world's gold, we decide we're going to make the US dollar more or less the reserve currency. Russia was involved in these discussions. They didn't like it and basically said it's a Wall Street power grab, blah, 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 blah. Fair enough. However, it was viewed as being successful in maintaining, or I guess I should say reducing volatility between other currencies and the FX exchange rates because of tight financial, I guess, regulation, right? And the ability to justify valuations, right? That's really kind of the big takeaway of this. So that was Bretton Woods I. Bretton Woods I died, so to speak, with the movement of our president in the United States to remove the US dollar being pegged to the gold standard. This did a couple things. It provided essentially more liquidity, right? Because we could start printing more money because we weren't restricted by the valuation essentially of the dollar to the gold. And it also created basically a fiat currency, right? So no longer was our dollar backed by true tangible gold. It was now backed by the full faith and credit of the United States government. What does that actually mean? It means this. Taxes, okay? So your dollar is worth something because of the ability for the United States government to impose or levy taxes. Therefore, all the people that hold dollars in reserves know that my dollar's worth something because the United States government can levy taxes on its people to repay their debt, and we always repay our debt. That's the idea. Now, after we left the gold standard, other countries decided, you know what? We're going to do it too, because it will help with economic expansion. And so we move into the free floating rate environment. Right? There you go. This basically moved us to the emergence of eventually the petrodollar, right? And you've probably heard that. And by the way, so here you go. Value of the currency derived by confidence in value. Placed importance on anti-inflationary monetary policy. That's actually a very, so I put it there for a reason. I should probably explain it, right? So the importance is placed on anti-inflationary monetary policy. Well, what have we been doing a lot of recently? Right? Yeah. It's not good for monetary policy, not even in the slightest. So anyway, this leads to petrodollar. So what's petrodollar? It's the next thing that you need to understand. Okay. Petrodollars, US dollars paid to oil exporting countries or country for the sale of a commodity, right? Denominated USD. The idea here was actually pretty simplistic. We went to Saudi Arabia, right? And we said, hey, we want to buy oil, right, for our economy. And we want to pay in US dollars, right? So we don't want to pay in gold. We want to pay in dollars. And our dollars are floating rate, right? They're not backed by gold standard, but we want to buy them from you. And here's why that's going to work out really well for you. If you end up allowing us to price oil with the US dollar, you will essentially be getting paid in a currency that is now pegged to a commodity, right? Specifically oil, that is a consumable, which has velocity, which is great, right? It gets used up. It's not like gold, buy a bunch of it, sit it in Fort Knox, wait for people to want it. Oil's got velocity. Velocity is important. So anyway, you're going to be able to benefit because you're going to be basically getting those US dollars, paid in those US dollars, that have velocity, that then get pegged to petro, that then basically you're going to get growth, right? You're basically going to get paid in something that's going to appreciate in value. That's the general idea, okay? So eventually there's surpluses, right? So the amount of money that is coming in, because we're consuming in the US oil, the number one consumer in the world, right? So we're paying dollars, and then they have a surplus of dollars. So they then, and I should say, so Saudi Arabia basically was the start, but then all the OPEC countries, right? They follow suit. Okay. So then this is where it's the petrodollar. Anyway, so dollar comes in, creates a surplus. And then those people that have those surplus dollars have options, right? So they can either use it domestically, so paying companies in their own countries in US dollars. So again, you're creating that expansion and that use of the USD as a form of, I guess, value or negotiation. You can spec this all the way back to the crypto world, right? So you're creating the velocity, you're creating wider usage, domestic consumption. They can invest in US dollars, right? They can lend it to other countries because now they can lend out USD and collect interest rate, yield farming, right? Okay. Or it can be invested right back into the United States through purchase of bonds and T-bills. So we're going to then basically pay out interest payments, the US, right, to these countries. And so that allows us to then take that money and recirculate it back through the system. So it's moved, right, out of basically holdings by individuals, comes back and then recircles out, and that's the basic idea of the petrodollar. So so what, right? Why do we care? Well, because, and again, come up here, right? Because value of currency derived on confidence on its value, importance of anti-inflationary monetary policy, right? So bird machine's been going and going and going. And so now here you go. This is the Bretton Woods, right? So Bretton Woods number one, gold standard, right? US dollar led. We ended commodity-based money. So, off the gold standard, right? And now we are technically in Bretton Woods II. The argument is being made that we are actually in 3. We just don't realize it yet, which that's what we're going to get to. But this basically died when reserves, so the Central Bank of Russia had reserve assets, right, that they have to basically put in to maintain their, I guess, compliance or liquidity requirements. And with the invasion of Ukraine, the U.S. and the Allies seized those assets, which then now has everybody saying, my dollars, right, are potentially at risk. They can be confiscated. Is this really a reserve? Is this really secure? And so then the argument becomes a move, right, to a Bretton Woods III, commodities, outside sources, right? And what it's going to be pegged to, we don't necessarily know yet. We may return back to various currencies that, again, It's based on what you have commodity-wise inside of the country, so forth. That determines your value of your currency. So the problem here, again, we're getting away from Bretton Woods I, which the idea, again, right here, obligation each country maintain external exchange rates within 1% by tying its currency to gold, ability International Monetary Fund to bridge temporary imbalances of payment. What we wanted to do was eliminate this, right? So if this is time, and then this is the value of exchange between pairs, which a lot of crypto people understand that, over time, we didn't want these large swings. We wanted it to be something more like this, more manageable, makes world economies work better, makes basically, orders and supply chain. It basically, it's good for global commerce, I guess is the way to look at it. So, this actually technically would be last week. So sorry. Like I said, we've been doing this a little bit. So Zoltan Pozsar puts out Credit Suisse, which you guys should know, is usually very conservative. Puts out a research article, basically saying, boom, Bretton Woods III. That's where we are. The sanctions against Russia, basically we're the inflection moment, and there you go, canaries out of the coal mine. Why does it matter? Well, yeah, right. So seizure of the central bank reserves. Okay, so this is where you got to go down the rabbit hole with me just a little bit. So let's talk about state of current economy, right? You've got Russia, right? Has invaded Ukraine. Okay. And with that, we ended up placing basically an oil embargo, right? And restrictions on Russian oil. Okay. So U.S. led, if you will. Not all countries are following suit, because not all countries have the ability, I would tell you, from a financial standpoint, to do that. They are heavily reliant on that supply. Next piece, gas prices, right? Now we've seen some relief last 2 days, but gas prices in general, it's been skyrocketing. We'll explain that here in a minute too. It all has to do with this. And part of that argument with increasing gas prices has been go buy a Tesla, which, sure, we'll talk about that too. But the point of Tesla, or whatever EV you choose, it requires rare earth materials. Hence, we've seen recently the run on nickel, right? Yeah, big time squeeze LMEs and trying to unwind some stuff, and it's been interesting. All right, so next thing, we've got Fed coming up here, right? Tomorrow, and you've got one of two scenarios how this plays out, right? Forgive me for my angled writing. Let me see if I can do this better. Scenario 1 and scenario 2. All right, scenario 1. War is imminent or possible, right? So if you go to war, right, if you start raising rates, you will definitely move us towards an inflationary or a recessionary environment, right? So if that is still a potential, then Burr has to, in some capacity, continue. Has to, right? So we were expecting, prior to all of this, around a half bips rate move. Now I think probably still going to get something, and I'll explain why, but I think we're going to be closer to a quarter bit. So it's most likely where we're going to be. Then on scenario 2, right, is no war, right? And then monetary policy kicks in. So with no war, means no burr, which means markets will react in what is hopefully a managed decline. And talk about that in a second. Okay. This has lots of recipes for major issues to the economy. This still also has significant implications, but again, the idea is more of a managed decline, slow pullback. Okay, so in the event that either of these scenarios plays out, right, where we get a managed decline or where we get full-scale war, right, you're getting this. Flight to safety, right? So typically cash, treasuries, right? Commodities, gold, silver, blah, blah, blah. You pick it. So flight to safety, liquidity out of markets. You guys have also probably been hearing about a lot of margin call issues, right? And even in oil. This stuff is all happening, which again, as this happens, this again has market impact and could be problematic. Excuse me for 1 second, I'm yawning. I apologize. And I'm going to have a beer because cheers. All right. Back to it. So, what does this mean? Why should you care? Well, let's start with what's happened with the oil embargo, okay? Because that's important to understand. All right. So let's start with some economics 101, okay? This is, let me make it a little bigger. There you go. Want some room to navigate on here. All right. This is a supply-demand curve. If you've never seen one, this is basically what it is in a nutshell, okay? On your x-axis, you have quantities produced. And here on your y-axis, you usually have your price per quantity. I hope this isn't too cranny looking. I know it's a bigger ink thingy or whatever, but anyway. And then this is your supply, okay? And this is your demand. And what happens is buyers and sellers are apart, right, on price and quantity until you get to here, right? And then this is magic. This is your equilibrium where the markets decide this is optimum production. The number of units that we will produce for the price, this is optimum economic action, right? If this is not at equilibrium in intersection, you have inefficiencies, right? And either surpluses or deficits, so it's economic utility is left on the table, so to speak, okay? So let's say that this dot right here, which is our equilibrium, right? This represents prior to Ukraine, prior to sanctions, prior to the embargo, everything, right? Well, what has happened is we've experienced a shift, okay? And that shift has been in the way of supply. And so our supply curve now is over here. And this is due to Russian sanctions. Okay. So our supply is shifted, which then moves our equilibrium to a new place. And we're going to talk about this too, because this is going to get even more interesting, because our demand has now actually even potentially shifted as well. But again, these are all all based not on the free markets, but unfortunately it's just based on sanctions. And well, I guess you could technically say China is economically driven due to COVID, but anyway, external factors and circumstances. All right, so what does this really mean, and why does it matter to Bretton Woods? Okay, so next drawing, if you will, is let's do it like this. All right. If this is price, right, and then this is our time, right, price over time, right, and in oil, okay, this is oil, right, whatever. Oil maybe goes something, like this, whatever, right? That's what we would expect potentially. Okay, again, whatever, doesn't matter. Very generalized. The point is this: at the moment, so going back up here, right, that we imposed sanctions. Again, this is the oil embargo, right? U.S. led, gas prices up. Go buy a Tesla, EV, nickel. Okay. We imposed those sanctions, and what happened was a divergence. Okay. Now, and again, this is not exact numbers. I'm trying to give very generalized information here so you understand the concept, not necessarily the actual valuations. So, okay. Half of the supply. So let's say Russia was half the supply. It's not, but let's do it because it's easier. Okay. Half the supply is now taken off of the market, right? And so that's why we see this shift, right? So S1 is here, but now this actually is technically just S1 half, if you will. So supply goes down by half, right? And then that drives up the price, right? Because there's less of it. We get scarcity in economics terms, right? So, but that oil didn't disappear. It's just not able to be purchased. And so it loses its value, right? It goes down in value. And now, unless there's a buyer, it continues to go down. But there is a buyer. And this is where we're going to get into the issue of Bretton Woods III and the bigger problem. What it also did is it increased the cost of the existing supply, right? So supply goes down, right? Because we took it off. So the existing supply that's available for purchase now has increased accordingly in price, right? Now, the mean, right, where oil should have tracked, that no longer applies. Now the United States is buying, right, its oil. Well, that didn't look good. It's buying its oil, right, right, at this premium. This premium over what it should be. So we have a divergence from NAV or par value on what oil should be. This other oil that is now naturally depressed, because again, remember, who's largest consumer in the world of oil? United States, right? Largest consumer, so we're not buying. So we're going to get our supply elsewhere. That's why we're going around, we're talking Saudi Arabia, well, trying to talk Saudi Arabia, Venezuela, Iran, so forth and so forth. So now this oil is really cheap. And if you're willing, you can buy it not only at a discount to what it should be, but at a significant discount to what the United States is going to be paying for it. So, who wins? Who are our geopolitical jockeying for, I would say, a bigger position in the world? Countries? The one that you need to worry about is China. Now, not just because of the oil, but oil is utility, right? So it's literally energy. We can quantify it. We know how many actual units of energy are in barrels, and we can drive efficiency to make that bigger, right? So using less per, but it's economic utility, it's efficiency. The United States, I mean, that's how our country grew in a lot of ways. So we in the United States will be up here paying premiums, right? on oil, which will slow our economic growth, right? Relative to whoever is buying oil down at these prices. So instead of us all having to compete on the same price point, now it starts to be an unfair advantage. So the other thing with China, as you're seeing these prices go up on oil, and don't let the government fool you. Don't let them tell you it's Russia's fault. It's not Russia's fault. Like the price points. I mean, these are these are choices that we're making. And by the way, being the U.S. petrodollar, this has all other sorts of complexities to it. But the thing to take away here, really at its core, inflation isn't because of Russia. Don't let them tell you that. Inflation is because we've been printing ourselves into oblivion, which again goes back right here, right? We left the gold standard. We moved to the petro US dollar, right? But the whole idea, value of currency derived by confidence in value, importance of anti-inflationary monetary policy, historically seen during the 70s and early 80s. We're literally repeating history, people. It's not because Russia decided to invade, right? Does oil affect everything? Sure, absolutely. Anything that's made out of plastic, anything that's a landing cost, produced, whatever, yeah, it does. But again, we were seeing CPI inflationary numbers that were much higher prior to any of this. Now what you've done is restricted the supply, right? So this is going to compound those issues significantly. So anyway, so China. Pete Buttigieg, the transportation secretary, right? He says, don't worry about that pesky oil, right? Those prices. Well, just go buy a Tesla. Go buy a Tesla. Sure. You guys know who has the vast majority of rare earth materials, right? China. So again, not political. Do we have the ability to develop energy independence to a degree here? Yes, especially using internal combustion engines. Yes, we do. Do we have the capacity to do EVs here? Not on the scale without having to utilize and leverage China. Is China our friend right now? I don't think so. China is buying that oil from Russia. So they are, again, jockeying to push us off as the world reserve currency, right? And now you have articles that came out today and I literally just talked about this last night. You have articles coming out today now talking about the Petro I. And that is alarming. It's starting to become more profound to where they're talking about it on Bloomberg, actually, even just about an hour ago. So it's a real issue. So what does it all mean? Well, for now, okay, you're seeing decoupling of the assets. So if this, right, now I'm just making a straight line, okay, but I want you to envision it like this, right, like a normal market line, whatever, it's up, it's down, doesn't matter. The whole point is we've had divergence, right? And so down here is all the stuff that cannot be bought, that has been taken off the market. And up here is everything that we can buy. Eventually, prices will peak. So we'll have peak to the trough, right? They will be maximized, right? And then they will eventually taper. So in the world of Bretton Woods III, the argument, which, by the way, Pozsar's, and we'll talk about this, his other piece is, let me put it up here so it's really bright, is Bitcoin, right? And how it will benefit in the event, man, you can't really see that. How it will benefit all the Bitcoiners forgive my use of a color that is not Bitcoin color, but anyway, how Bitcoin will benefit in the event that it is still around, and I'll explain that in a second. So, coming back down here, divergence, right? So, as long as we are experiencing, right, this sanction and this lower amount of supply, right, that, if all things hold true, continues to raise the prices, right, of what we are paying. And it continues to lower the prices of what China would pay if they're stockpiling. So think about it as a stockpile versus usage, right? So if they're down here stockpiling, you know, anything, commodities, gold, silver, platinum, nickel, you know, palladium, like whatever, all of it. They're buying from Russia at these deep discounts. And so they buy the bottom, and we've been spending all the way to the top. And then our stuff starts to become less valuable. Their stuff starts to become more valuable. So when we get back to normalcy, right? So think about it like this. If the supply went down, right, what was available for us to buy, right, US, our prices go up. However, if the supply increased, right, for China in terms of what they buy, if this was Russian, right? So this was what it was. Someone's going to guess, you know, no. Supply increased actually for them, so their overall price goes down, and then they say, yeah, let's buy up that surplus value. It's basically what it is. So they end up grabbing at a good discount. It's like dollar cost averaging, right? You gotta sit on it and sit on everything. And then their economy grows because they were able to basically fund or build their economy at a price point that is not only below, right, like what par or mean should be, but it's disproportionately below what the rest of the world is paying. So all our expenses continue to go up. Everything for them disproportionately, they're building or capturing value, if you will, which then makes the case for strengthening of their currency, weakening of the US dollar, and things start to get basically worse. So anyway, so that's why you're seeing now the push for a movement, Bretton Woods III, right? What does it mean? Commodities, right? So it's not necessarily he who has the gold makes the rule anymore, right? It's he who has the commodities that are going to be necessary for economic production or value or just even just the engine of the economy of countries to survive. He who has the gold makes the rule. The gold's changing. The gold's oil. The gold's rare earth, right? The gold's all the stuff, all the resources on the planet. So I know it's doom and gloom, but that's a harsh reality. So anyway, we've kind of shot ourselves in the foot, right? Again, right back here, value currency derived by confidence in its value. We have printed it. The only thing that we had going for us is the fact that everybody was experiencing COVID at the same time, right? Everybody was. So because everybody was experiencing it at the same time, right? We technically we're all sharing this line, right? Everybody was. Everybody was impacted by supply chain challenges. Everybody was impacted by, the cost of energy, everything. Everybody's experiencing it the same. But it is the sanctions, right? It is the sanctions that are now creating this opportunity. And that's the concern. So China literally has not really spoken out about the situation in Ukraine. Why? They welcome the sanctions and they want to basically be able to buy, right, all of this up. let's buy all this supply up, right? When the supply is off the market, let's buy it all up at a discount. So their price point, they're buying it somewhere down here, right? And then when the markets return to normalcy, so whenever that is, war stops and we get back, right? We return to equilibrium. But we will have given up economic growth and value here, right? And they will have captured. And so it's simply about time. The longer this continues, right? This divergence, the longer it happens, the more essentially economic value China is able to capture below what the free rate or the par value or the face value should be, right? And so this will translate into economic prosperity for their country. And the longer that we, as the United States, have to stay above this line, due again to the oil embargoes, because it's not like it's, nobody's buying it. Somebody's capturing that value. And in this case, the people capturing the value are China. So the longer this holds, this trend exists, the more progress they make at chipping away at the U.S. petrodollar. And again, Saudi Arabia is having conversations with them right now. I mean, this is very real. If the U.S. dollar gets removed as world reserve currency, we either go back to pre-Bretton Woods, right? So one of a couple things happens, right? Either this doesn't happen, so there is no Bretton Woods III, right? But that's still very, very possible. We either go back pre-Bretton Woods, right? And so that means everything starts to operate as little satellites of currency, like in the global economy, and it's messy, and we get higher volatility on exchange rates, right? So currency's doing this again, right? And so we're having to endure those big volatile swings based on when we're buying and selling, which slows down expediency in global supply chains, really kind of mucks the whole thing up. So that we could go back to that, or and then this is the argument, or it's commodities, right? But the definition of commodities could also potentially include Bitcoin, right? Bitcoin specific is what's being referenced if it's around, but it could also be outlawed, banned. I mean, again, it's who's willing to accept it, right? Oh, we're not going to take Russian oil. Okay, well, China's willing to. So they get it at a discount value until things move on. It's it's shifting and it's dynamic. And speaking of dynamics, so now we've got a shift on demand with China and Shenzhen port. So one of the top 5 ports in the world being shut down, right? So alternative demand shift, right? So now, technically, where are we? No, we'd be here. So you can see some potential relaxing on pricing, right? But how long does that last? And again, I'm sure they'd love that, right? Hey, let's just shut down our biggest port. Let's drive the cost disproportionately down even more, so we can buy it at even a deeper discount rate. There's some real economic strategy that's going on here. So anyway, this is basically, in a nutshell, what the article is saying. We could be heading for the end of the petro-US dollar, right? And largely driven by the fact that we seized from a central bank reserve assets that were required, right? So the argument becomes, is your money really safe if it's not in your own hands, right? And so that then pushes things back to countries trying to jockey and say, well, we have value, right? We have commodities, we have whatever, we have these things. So currency should be based on our currency, or we're not going to play, a standard, reserve currency, one country's, currency is the world reserve, because if that country fails, right, fails to deal with anti-inflationary monetary policy, right, like and keep inflation in check and maintain its value and avoid debasement, we don't want it. So that's basically what it is. It's some real kind of sobering, eye-opening stuff. But anyway, I hope this was valuable to a certain degree. And, again, could we see some relaxing oil prices short term? Yeah, but again, this really goes, number one, to this, right? Our economy is very complicated right now. If we don't increase essentially interest rates, we stand to accelerate, right? Accelerate this even further, right? By devaluing, debasing the dollar, adding inflation into the equation. And so in some ways, right, we need to raise rates to combat inflation, to maintain the value of the dollar. But at the same time, if we are stuck in a war scenario, that could lead straight to economic recession. And, we thought COVID was bad. I mean, it could get way worse. Scenario number two, right? This is out of these two scenarios. If you had to have one, right, this is probably the more ideal one, right? No war, clearly. Nobody wants war. We stop printing money, economic activity returns, and the market does more of a managed decline, right? So even kind of hearkening this, right? Overinflated, and then we slowly bring prices back to reality. That would be probably the preferential scenario. But because right now, right, there's a lot of unknowns about what the Fed's going to do, what Russia's going to do, the general state of the economy. Again, flight to safety, and that's basically what we've been seeing. We've also been seeing clearly the margin calls, because cost of capital has been so cheap. There's been high degrees of leverage inside the markets to squeak out final gains. But anyway, that's pretty much it. That wraps it up. Hope I didn't beat it like a dead horse too badly, but hopefully of value. Hopefully it at least will make your brain start clicking, and you can let me know if you got any questions or anything we want to revisit. But again, this is where we are. So we're living in interesting times, people. Stay safe out there. Be smart with your investments. And I wish you all the very best of luck. Take care.